You know, I've been staring at the tape for, well, since the Asian Open last night, really, and there's something about the way this price is moving that just doesn't sit right. It's not the speed. We've seen speed before. We saw speed in March 2020. We saw it back in 2011. It's not the volatility itself, it's the indiscriminate nature of it. Usually, when you get a 33% drop in a major commodity like silver, and that is the number, 33% from the Friday high to this morning's limit down, usually that kind of violence is accompanied by a fundamental catastrophe, a mine collapse, a war ending, a central bank announcing they're selling their entire reserve. You look for the news, you find the headline, and you go, okay, that explains the panic. But you look at the news wires today, February 2nd, and what do you see? You see headlines about Kevin Warsh getting the Fed nomination. You see chatter about the dollar index ticking up 1% or 2. And look, those are real factors. I'm not dismissing them. But a new Fed chair nominee doesn't wipe out a third of the silver market's value in 48 hours. That's not how valuation works. That's not how sentiment works. This isn't sentiment. I've been watching the order flow, specifically the size of the sell blocks hitting the bids since the CME opened this morning, and it's telling a very different story, a much colder story. See, usually when a market crashes, it's because people are afraid. They want to get out, they think the price is going lower, so they sell to preserve capital. What we are seeing right now, this isn't fear. This is mechanics. This is a machine flushing out leverage. There is a specific signature to forced selling. It doesn't care about support levels. It doesn't care about the 200-day moving average. It doesn't care about RSI being oversold. It just hits the bid until the liquidity is gone. And if you look closely at the timestamp on the biggest waves of selling, they line up perfectly, almost suspiciously perfectly, with a distinct operational change that happened over the weekend, a change in the plumbing of the exchange itself. Most people are looking at the chart and asking, why does the market hate silver? That's the wrong question. The market doesn't hate silver. The market is currently physically incapable of holding the positions it had on Friday afternoon. I want to walk you through exactly what broke. Not the why that the news anchors are guessing at, but the structural how. Because if you don't understand the mechanism that triggered this, you're going to look at this price drop and think it's a buying opportunity. Or you're going to think the thesis is dead. Both of those reactions are dangerous right now. There is a document that went out late Friday. It wasn't a press release, it was a notice to members. And in that notice, there is a single percentage change that effectively made it illegal, mathematically illegal, for thousands of traders to keep their positions open this morning. What we are watching isn't a market making a decision. It's a liquidation engine running a script. And until that script finishes, until the math balances out, looking for a bottom is like trying to catch a falling knife while blindfolded. Let's look at the numbers. And this brings me to the first group of people who are completely misreading the situation. You have the narrative chasers. These are the folks looking at the appointment of Kevin Warsh and screaming, the Fed is going to crush inflation, silver is dead. Look, Warsh is a hawk, we know this. His nomination signals a strong dollar policy. That's bad for metals in a vacuum. But a policy shift takes months to ripple through the real economy. It takes weeks to reprice a bond portfolio. It does not cause the price of silver to drop 33% in 2 trading sessions. That is a 3 standard deviation event. That is a statistical anomaly. You don't get that from a change in Fed leadership. You get that from a structural break. The people who are exposed right now aren't the physical stackers. If you have coins in a safe, yeah, the fiat value is down today, and that feels terrible, I get it. But you still have the ounces. No one is coming to your house to take them. You aren't exposed to the mechanism. The people who are exposed are the CTAs, the commodity trading advisors, and the leverage hedge funds who are sitting on massive long positions late last week. They were playing the breakout. They were betting on the momentum, and they were doing it with borrowed money. When the CME raised the margin, the math stopped working. Here is the hard data point that matters more than anything else right now. Open interest. I'm looking at the preliminary data from the Asian session, and we saw a massive contraction in open interest alongside the price drop.
Why is that important? Because if traders were bearish, if they really believed silver was worthless, you would see open interest increasing or staying flat as new short sellers enter the market to bet against it. New shorts create new contracts, but we aren't seeing a flood of new shorts. We are seeing the destruction of existing longs. That's the difference between a sell-off and a liquidation. A sell-off is a debate, buyers and sellers arguing about value. A liquidation is a hostage situation. The seller doesn't care about the price. They aren't looking at a chart thinking, $22 looks like good support. They're looking at a margin call notification that says deposit $5 million immediately. They can't deposit it, so the algorithm takes over and hits market sell. And this leads to the contradiction that most people are missing. Everyone is saying silver is crashing because nobody wants it. I would argue the exact opposite. Silver is crashing because it is the most liquid asset these funds have, and they are desperate for cash. You don't sell what you hate in a liquidity crisis. You sell what you can sell. When the margin clerk calls, you don't sell your illiquid private equity stakes. You don't sell your real estate. You click the button on the most liquid futures contract you have. Silver is being punished for its liquidity. It's being used as an ATM machine to pay for the sins of leverage. In a minute, you'll see why that distinction changes everything about how you should handle the next 48 hours. But first, you have to understand the scale of the trap. See, when that margin hike hit, it didn't just affect the guys who were barely hanging on. It affected the big players too, because these funds run on models. They have value at risk models, VAR. These models tell them how much risk they can take. When volatility explodes, like it did on Friday, the inputs into those models go haywire. The model screams, too risky, reduce position size. So even the funds that have the cash are selling. They aren't selling because they're broke, they're selling because their risk management software is automatically forcing them to trim their exposure to stay within compliance rules. It's a mechanical feedback loop. The price drops, volatility goes up, margins go up, risk models scream, funds sell, price drops more. This is where most people get trapped. They look at the screen and think, the market knows something I don't. They assume the price action is rational. They assume the drop is predicting the future. It's not predicting the future. It's settling the past. It's clearing out the bets made in January. And if you think the appointment of a new Fed chair is the reason we are limit down, you have to ask yourself, why isn't gold down 30%? Why isn't copper down 30%? They're down, sure, the dollar is strong, but silver is taking a beating that is mathematically disproportionate to the rest of the commodity complex. That disproportionate move is the smoking gun. It tells us this is specific to the silver contract structure and the players involved in it. It tells us that silver was the most crowded trade, the most leveraged trade, and therefore the one with the smallest exit door when the theater caught fire. Now, I want to be clear about something. When I say this is mechanical, I am not saying it's manipulated in the sense of some evil guy in a dark room pressing a button. That's a comforting story, but it's lazy. It's actually scarier than that. It's a system working exactly as it was designed to. The exchange is protecting itself. The brokers are protecting themselves. The risk models are protecting the funds. Everyone is acting rationally to save their own skin, and the collective result is a catastrophe for the price. But there is a signal hiding in this carnage. Usually, when you see a crash like this, volume is highest at the beginning. Everyone rushes for the exit at once. But if you look at the volume profile from today, the selling pressure hasn't tapered off. It's coming in waves, systematic waves. Every time the price tries to bounce, it gets slammed back down. This next part is where it stops making sense if you're looking at fundamentals, but makes perfect sense if you understand the plumbing. Those waves, that's not new news hitting the wire. That is the margin cycle. See, margin calls aren't all issued at once. They go out in batches. First, the retail guys get liquidated, then the smaller prop firms. Then the larger funds have until a certain time of day to wire funds. If the wire doesn't arrive, boom, another wave of selling. We are watching a slow motion car crash where the cars are colliding one by one on a schedule. And this brings us to the forward-looking problem. If this is just a margin flush, it should end when the leverage is gone, right? That's the hope. That's the V-shaped recovery thesis. You flush the weak hands, the price snaps back. But there is a danger here that is much bigger than just a few over-leveraged traders losing their shirts. It's about what happens to the physical market when the paper price detaches this violently from reality. We've seen premiums on physical coins and bars start to widen today. The spot price says one thing, but try buying an eagle or a maple leaf for that price. You can't. The dealers are widening their spreads because they don't trust the paper price either. We are seeing a fracture. The paper market is screaming sell because it needs cash. The physical market is whispering wait because the metal hasn't changed. This divergence is dangerous. It creates a vacuum, and in that vacuum, things break. So we have a market that is down 33%. We have a narrative about a hawk-fed chair that is providing convenient cover for a mechanical flush. We have a margin hike that changed the rules of the game overnight. But what I'm watching next, what I'm going to explain in a moment, is the mechanism that determines whether this stops here or whether it breaks something fundamental in the global collateral system. Because silver isn't just a shiny rock. It's a collateral asset for trillions of dollars in other trades. And if silver falls too far, it doesn't just hurt silver bugs. It starts triggering margin calls in other markets. It starts to bleed into equities. It starts to bleed into bonds. That is a contagion risk. Most people think this is a silver story. It's not. It's a liquidity story. And if you're holding or thinking about buying, you need to understand exactly how the limit down mechanism works, because it's the only thing keeping this market from going to zero right now, and it might also be the thing that traps you in a trade you can't get out of. And that brings us directly to the mechanics of the floor. You might have seen the phrase limit down flashing on your screens today or in the news tickers. It sounds like a safety feature. It sounds like the exchange saying, okay everyone, let's take a breath, things are getting too crazy. But if you have ever been stuck in a trade that went limit down, you know it is not a safety feature. It's a page. Here's the mechanism that most people are missing right now. When a market hits limit down, trading doesn't necessarily stop. It just means the price cannot go any lower. But here's the catch. You can still buy at that limit price. The problem is nobody wants to buy. Everyone wants to sell. So you have a stack of sell orders piling up at the limit price, millions of ounces trying to get out, and zero buyers stepping up to take them. This creates a terrifying illusion. You look at the chart, and for the last few hours, it looks like a flat line. It looks stable. You might even think, oh good, the bleeding stopped. We found the floor. We haven't found the floor. We hit a wall. The price isn't flat because buyers and sellers agreed on a value. It's flat because the exchange turned off the downside. The selling pressure hasn't vanished. It's just invisible now. It's building up behind that dam. And the moment the market reopens fully or the limits are expanded, which they will be, that dam breaks. This is the behavioral signal that separates the tourists from the professionals. The tourists look at the flat line and feel relief. The professionals look at the order book behind the flat line and feel terror because they can see the imbalance. They know that for every one contract bought, there are 50 contracts trying to be sold at any price. And this leads to the second part of the trap, which is the spread between the paper price and the street price. I mentioned this briefly, but we need to dig into it because this is the divergence that kills accounts. Right now on the screen, silver is down 33%. It looked like a bargain, but go try to buy a physical bar from a major dealer. Go ahead, call your broker, check the websites. You are going to see one of two things. Either they are out of stock, which is code for we aren't selling at these fake prices, or the premiums have exploded. The spot price might say X dollars, but the physical price is X plus 20%. Why? Because the physical market knows this is a paper liquidation event. The bullion dealers aren't going to sell you their inventory at a 30% discount just because some hedge fund in Connecticut got a margin call. They know the metal has value. They are waiting for the paper storm to pass. This is critical because it tells us the asset itself isn't broken. The pricing mechanism is broken. But, and I need to be extremely careful here, I need to tell you exactly what would prove me wrong. I'm building a case that this is a mechanical flush, a temporary dislocation caused by leverage, but I have to be honest about the other side. There is a scenario where I am completely wrong, and this is actually the start of a secular bear market. What would invalidate my entire thesis? If we look at the open interest data tomorrow morning, and instead of seeing it drop, which means old positions are dying, we see it explode higher, that changes everything. If open interest is rising while price is crashing, that means smart money isn't just liquidating, they're aggressively shorting. It means big institutional players are stepping in and betting billions of dollars that silver is going lower, much lower.
If I see new shorts entering this market in size, I will tear up this script. That would mean this isn't just a margin call. That would mean the market sees something fundamentally broken in the economy that I am missing. Maybe they think Kevin Warsh is going to raise rates to 8%. Maybe they see a deflationary collapse that wipes out industrial demand. If new bears are entering, the mechanical flush theory is dead and we are in a true crash. But that is not what the data shows right now. Right now, we see liquidation. We see old money leaving, not new money entering. So where does that leave us? It leaves us staring at two very specific paths forward, and you need to be ready for both because the market is going to choose one in the next 24 hours. Path 1 is the liquidation cascade. This is the ugly one. This happens if the selling in silver is so violent that it breaks the collateral chains I mentioned earlier. Remember, funds use their gold and silver positions as collateral to borrow money for other trades. If the value of that collateral drops 30% in 2 days, the bank calls them and says, "Your collateral is worthless, send cash." To get that cash, they have to sell other things. They sell stocks, they sell bonds, they sell Bitcoin. Suddenly, a silver crash becomes an everything crash. We saw this in March 2020. Silver collapsed and it dragged everything else down with it because it was the source of liquidity. If we see the S&P 500 start to tank in lockstep with silver tomorrow, we know the contagion has started. That is the maximum danger zone. That is when you stop trying to buy the dip and you start worrying about capital preservation. Path 2 is the snapback. This is the scenario where the mechanism finishes its job. The over-leveraged longs are wiped out. They are gone. The weak hands are empty. The selling pressure simply runs out of fuel because there's no one left to sell. When that happens, the price doesn't just drift up. It snaps. It's like holding a beach ball underwater and then letting go. The moment the selling pressure lifts, the physical reality, the shortage of metal, the high premiums, the industrial demand takes over again. And because the liquidity is so thin, the move up can be just as violent as the move down. We are sitting right on the edge of that binary outcome. The limit down wall is the only thing holding back the flood, or it's the platform for the bounce. And there's one more signal I'm watching that most people ignore. It's the behavior of the miners. Usually, miner stocks are a leveraged play on the metal. If silver drops 1%, miners drop 2%. But look at the big silver miners today. They're down, yes, but are they down 30%? No. Many of them are holding up surprisingly well compared to the commodity. They are showing relative strength. That is a whisper from the equity market. The equity investors, who look at long-term cash flows, not just short-term futures contracts, are saying, we don't believe this price action. They aren't panic selling their shares in the companies that actually dig this stuff out of the ground. When the stock of the producer refuses to follow the price of the product, you pay attention. It suggests the smart money in equities sees this as a temporary storm, not a climate change. But you cannot trade on a suggestion. You have to trade on what's in front of you. And what's in front of you is a broken market that hasn't found equilibrium yet. The danger now is recency bias. You look at the drop and think it has to bounce because it's fallen so far. Or you think it has to keep falling because the momentum is so strong. Both of those are emotional reactions. The machine doesn't have emotions. The machine has a ledger. And until that ledger balances, until the debit column equals the credit column, the machine will keep grinding. We are in the gap between the forced selling and the value buying. The forced sellers are almost done. We know this because of the volume. We know this because of the open interest drop. But the value buyers, the big sovereign wealth funds, the industrial users, they haven't stepped in yet. They are like sharks circling. They smell blood, but they are waiting for the thrashing to stop. They aren't going to try to catch the falling knife. They are going to wait for it to hit the floor, stick in the wood, and stop vibrating. Then and only then will they pick it up.
So the question you have to ask yourself isn't, is silver cheap? The question is, has the thrashing stopped? And looking at the after hours tick data, looking at the way the spreads are widening, I don't think the thrashing has stopped yet. I think we have one more flush to go, one more wave of pain to clear out the final holdouts who prayed for a bounce today and didn't get it. When they capitulate, when the last optimist throws in the towel, that is usually the exact moment the bottom is in. But we aren't there yet. We're close, but we aren't there. So what happens when the sun comes up? We are entering the resolution window. Forget guessing. We need a decision tree. There are two paths forward. First is a contagion bleed. Watch the opening tick. If silver gaps down and drags the S&P 500 with it, the firewall has breached. That means forced selling has mutated into systemic risk. If correlation goes to 1, cash is the only position. Second, and more likely, is the flush and reversal. The market gaps down, panic peaks, and then a vertical wall of volume hits. The price stops and churns. That churn is inventory transferring from forced sellers to value buyers. If we see that volume spike followed by a reclaim of the lows, the leverage is cleansed. But don't be a hero. Let the train hit the barrier first. Missing the absolute bottom is better than catching a falling knife. Here's my playbook for the next 48 hours. 1. Zero leverage. The CME changed the rules. Volatility will wipe out leverage positions even if you're right. This is a spot market game now. 2. Watch physical premiums. If the paper price bounces but premiums stay sky high, the physical shortage is real. That divergence leads to a massive squeeze later. 3. Ignore the news. The Kevin Warsh headlines are backward-looking noise. Watch the curve. Backwardation in the futures market screams physical tightness. You cannot have a bear market when people are desperate for immediate delivery. We will look back at this Monday massacre as a cleansing fire. The speculative froth is burning off, leaving only the bedrock of industrial demand. This is a clearance sale for strategic buyers. I am patiently bullish, waiting for the mechanism to finish. When the forced selling runs out of energy, physics takes over. So, are you watching the price or the volume? Price lies, volume is the truth. I'm tracking a specific commercial short threshold overnight that mathematically confirms the bottom. I'll share that number in the next update. Until then, stay liquid and don't let the machine force you into a trade you didn't choose.
You know,